A lot of the drama in the stock market now revolves around Tesla, and it's really it's like holding up a mirror. What do we want? I hate to get philosophical. Soros is very philosophical. What do we want from the market? And there's a tug of war between the people that want to believe you can have a generational entrepreneur that's kicking ass, it's going to do unbelievable things, and that's worth $1 trillion. And you're supposed to suspend disbelief about this, basically backward-looking things like financials. And people like Bezos proved financials are backward-looking. Elon Musk is at the forefront of AI, robotics, and other high technologies. How can you bet against him? He's gonna figure it out. He's gonna make lots of money from whatever it is he's working on. But the other side of the tug of war, on the other side of the rope, are people who are saying, great, but I'm not going to pay for that. You got to show me. There's a lot of great technologists. Ray Kurzweil. And the other side's going to say, well, Ray Kurzweil never made $1 trillion company. And the other side of the rope says it shouldn't be $1 trillion company. And the other side of the rope says, no, he look at all the revenue Tesla has. Tesla's got a lot of revenue, a lot of earnings. They've done really well. You've probably ridden in a Tesla. And the other side says, yeah, but, Ford and Toyota are just as good, and they're worth, so little. How can Tesla be worth so much? And the tug of war will continue. And what you are probably asking of yourself or of me or others is, well, who's going to win the tug of war? And I don't know that that's the right answer or the right question. I would ask the opposite question, which is, who do we want to win the tug of war? Who are you going to let win the tug of war? Because as a market, we decide. Right? If the earnings of a company have to be contemporaneous with the stock price, we'd have a very different stock market, right? It'd be highly arbitrageable. You could buy the stock of a company that just got FDA approval for a drug that has no earnings, but earnings are about to explode. So it's a cure for some disease, right? The earnings are going to come. It's basically preordained. So that's kind of like what Tesla is. There's this assumption that the earnings are going to come someday. But the tug of war, one of the sides wins when, earnings are not going up this year as fast as you might think. It's going to be maybe next year. And they say, aha! This is what I've been saying all along. The earnings are not going to go up. And this promise of next year, well, there is no next year. That's a lie too. They lied about this year and they're lying about next year. Earnings are never going up again. And the other side has faith and says, no. We believe in our guy. He's going to do just fine. And, you basically have a tug between faith and reason, which is like, maybe more meta than we wanted. But that's why it's hard to pick this, because you're dealing with this very meta concept of, you don't know which side is right. Right now, the side that's pulling on the earnings stuff, it certainly seems to be right. That Q1 was a doozy. Big decline in shipments and deliveries and production for Tesla. But, we've seen what Musk has done over the last 20 years. Pretty impressive. So I don't know that he's not going to figure it out. So which side? And a lot of the market is fixated with this exact question right now. And on days when the recession could be looming and equities are overvalued, Tesla slips. On days when there's reasons to be optimistic and we're excited about innovation, Tesla's rising, like today is up 4%. And one thing I'll tell you is that, kind of as a value investor, is what I care about a little bit. This is more about a method for investing, not about whether I'd be long or short or whatever. This method for investing is, okay, let's say you have a stock or this is a company. And this is what I'd call the margin of safety. This is not the price. This is different. This is the margin of safety. What is this, anyway? So this, to me, is kind of like the value, the permanent value of the company. What does that mean? In pharma, we actually don't get this, which is frustrating. And permanent value is kind of the moat. And this is the earnings that you can kind of rely on for a long time. For Coca-Cola, that's like basically the whole company. But we'll get to that in a second. So this is the stock price. And maybe we're here right now, I don't know. This isn't supposed to be representative of Tesla exactly, obviously. And so the question is, for the black part, you can kind of assume that you're going to be right. When you're in the black part, you have permanent value that you can sort of sit on and say, I can be long because it's worth, this many times earnings, and it's very stable, and the price supports kind of the value supports the price. When Tesla's all the way up here, you're sort of saying, okay, well, the car business is worth this much, but, the stock's worth a lot more. So either I'm making the wrong assumption about the car business, or there's something else coming, but, this price doesn't really correspond to reality just yet, as far as I can see empirically. And then there's other stocks where what you see is what you get, and that these lines are superimposable in essence. The value of Coke is largely been built up over some, decades, and it's sort of reached an asymptote. And the price of Coke, interestingly, I remember this, believe it or not, kind of overshot this. And Buffett famously said that one of his biggest mistakes was not selling in that period, because this is one of the core dilemmas and sort of advanced value investing is, if you have a compounding machine, should you ever sell? And Buffett's publicly said no in the past. And I think that the reality is some others have said, and including Buffett, have said yes. There is a price that's too high for everything. Coca-Cola is a wonderful compounding machine on its return on equity and its return on assets and things like that. The so-called Buffett return I've described a few times. But you're not getting the price of the original owner. Even if you are the original owner, there is a price that's sort of saying, I'm going to, like this was like 30, 40 times for Coke. And Coke was not growing. It made no sense. This was roughly 2002. And on the assets, like, okay, so this is the Coke plant. This cost, $7 billion in CapEx to create and to maintain. And this is generating $7 billion of cash flow a year. That's 100% return on assets. Well, that's wonderful, but how does that help you as a stockholder? Because the stock's at, 200 billion market cap. Do you really want to pay 200 billion for 7 billion? You cannot increase this return, otherwise they would. And that was the sort of folly of Buffett. And I think he said it was one of his biggest mistakes. Is great, this compounding is fantastic, but I already got the benefits of that. And I cannot compound exactly. I'm only just going to get this 7 billion every year. Now I'm going to get the 7 billion and I could buy back this guy. But at a certain price, is this a sale? At $1 trillion, is it a sale? And the previous message was, no, at no price could it be a sale. And the new message is, at the right price it's to sell. There's no business quite like Coca-Cola, it's true. But there is a price that, having a reliable cash flow stream, there are other reliable cash flow streams out there. Maybe you'd argue there's none quite as reliable as Coke, but okay, discount a $7 billion annuity at 1% risk. That's worth $700 billion, right? It's cash flow. How do we do this? Cash flow divided by discount rate, right? So 2%, it's 50 times, which is 350. And at 3%, you're at 3% discount rate, which you can get from bonds and other things. So is Coca-Cola safe? Sure, but is it safer than a bond? A senior secured bond in the US government? No, it's not as safe as that. So it's overvalued. So this is a philosophical question. Now, getting back to the point of Tesla, there are markets and situations where investors largely, the investors with the marginal capital remaining are only investors who are sort of comfortable living in the black zone. In high risk markets, they're investors with flush with cash that are comfortable living in the orange zone. And that's why they are living in the orange zone. That's why the price of Tesla is 100 plus times earnings, because there are people willing to buy it and sell it at that price. When capital evaporates in a big market crash or a fear or panic, whatever, the only people who have capital, like Paul Singer at Elliott and other value investors like Buffett, they don't buy stocks in the orange zone. They only buy stocks in the black zone. So the prices have to go to the black zone. So this is really, when I describe that tug of war, it's really a philosophical question more than it is like a question with an answer. In essence, you could argue that it's an M1, M2 question, an M3 question. It's a money supply question. Is there money? If people have money, they will do stupid things with it. They will invest. They will speculate. They'll buy IonQ and Rigetti and D-Wave. But they'll also buy good companies like Tesla. Tesla's a great company. Elon's maybe the best entrepreneur ever. I say that with a huge ego. So, what you're really asking is, when will the money supply change? Because that's really what matters. And sometimes when you're looking at these stocks, what's more important is, what is their ability to capture people's imaginations? That's why quantum rallied, right? That's why all these quantum stocks are up a lot. They were capturing people's imaginations, and there's tons of cash. Tons of cash. No unemployment, so people had money from that. Rising prices and everything, so people had money from that. And so you had companies that are talking about a new kind of computing. Well, you missed the old kind of computing. That was called NVIDIA, parallel computing. You probably missed the first kind of computing, the x86 in the 80s, 90s. You maybe weren't even born yet. So you say, I want the next kind of computing, and that's quantum computing. Okay, great. Whether that's true or not doesn't matter, because you're looking to gamble. You're looking to speculate. And when people take the money away, you can't speculate. There's no money to speculate. You need money for pharmaceuticals. You need money for rent. You need money for surgery. You need money for a rainy day. Maybe it is a rainy day. You need money for a hurricane. It's when it's bad out there, you can't buy stocks. Why? You might say, well, I save money more. No, I'm not talking about you. When in 2008, my partner and I, Marek, were sitting in his attic, studying stocks every day. I was basically unemployed. My hedge fund had not done well. And like I said, I made a big bet that the market would crash in 2007. I was wrong, because it crashed in 2008. And it was too early. So I was licking my wounds, like a cat. Sitting there with Marek, reading Munger, reading Buffett, forming this philosophical framework that would carry me forward. We started trading and betting with the money we did have, but we didn't have money from institutions. We didn't have money from big backers like CalPERS. our big backers said, well, or my big backers, I should say, said, well, you know, you bet on this market crash and you were wrong. You know, you had the right idea, but it didn't work. So that's that. But the funny thing is, every other fund had the same problem. People took money out from Citadel. Citadel was down 50% at that time. My boss, a Tiger Cub, who had done marvelously, he was up all the time, but he wasn't up enough. You know, he had good returns, which was really hard to do in that environment, but he was up, you know, 10% or 12%, stuff like that. And they said, well, we need that money too. This is New York firefighters, New York pension, Port Authority, guys like that. These guys put 10, 20, 30, $40 million in hedge funds. You don't. You might put $1 million in a hedge fund, maybe. So, you know, those guys needed their capital. And they said, give me the capital back. So even a guy like that, who had 2 or 3 billion, now he's got 200 or 300 million, or something like that. I don't know exactly. And Citadel, who had, you know, 20 billion, now he's got 10 or 8 or whatever. And they're looking at stocks and they're saying, wait, we're deep in the black zone. We're deep in the black. We don't need to speculate. We're paying 2, 3, 4, 5 times earnings for this stuff. But the point is they don't have capital. There's no capital around for people to buy the stocks. Everyone knew they were cheap, but there's nowhere to buy. I wish I had a couple $100 million I could trade with, where I could go buy Procter & Gamble for 8 times earnings, and J&J for 10 times earnings, and Pfizer for, I calculated, was around 5 times earnings for the base portfolio. Of course, it was a no-brainer. You don't have to be Warren Buffett to see that. But nobody had the capital that they were willing to risk. They were willing to buy treasuries. They weren't really willing to buy stocks. Stocks had just got decimated. We didn't know the future. We didn't know if there was going to be a banking system. So we're in that black zone. And right now, we're sort of still in this orange zone, probably high in that orange zone, in my opinion. We're starting to come down closer to the black area. And having capital is important right now. And avoiding speculation, deep speculation, is also important. And I feel like it's more important sometimes, we were talking about macro earlier, to know, you know, am I buying speculation or am I buying reality? Now, I don't focus on this, right? I focus on what's real and what isn't. Well, the thing is, when things are real, maybe they'll go from the top of the orange to the top of the black. And when things are not real, maybe they'll go from, that's not a good one. Maybe they'll go from the top of the orange to the bottom of the black. So you'll get some separation. But when things are good, the crappy stocks tend to be in favor, right? You want the crappiest stock you can find, because the dumbest people are going to speculate on it, and the smart people are not going to basically just get out of the way. They're not going to keep the price honest. And we've seen that, right? We've seen it 100 times with these stocks. Fartcoin is up lately. So if there's money flowing, you know, it'll behave both intelligently. It'll buy good stocks and good companies and fund new ventures and things like that. But it'll also behave irrationally, because humans are irrational. And people who missed a boat get FOMO. They get greedy and they want to chase the next thing. So it doesn't mean that, you know, we should sit here and try to take the temperature of the market every day and see if, you know, whether it's going to change. The reason I tell you this long, elaborate story is because our job is just sort of sit here, keep our capital, and just sort of sit here and wait. And if something crosses this boundary, remember, this is the average stock, but this is composed of hundreds of little stocks, like, let's say, this purple one. This purple one is rising like this. And say over here, when it falls, it's falling into the black territory where we feel comfortable buying it. But up here, we're not so comfortable. We want to sell it. This is the kind of stock that, you know, we'd sit and wait to buy. And if there's something really crazy, it's never reasonable, but that's so out of bounds of normal that it'll probably never be in the black zone value-wise. We maybe try to short that, because eventually it's going to come into and have to meet reality. Whether it's going to do that in a good market or a bad market, we don't know or care. Cassava did that, even though we're still in a very frothy market where lots of orange stocks exist. That doesn't mean there's not, price action and price discovery that will, help people realize. For example, we can still have a bull market, but if quantum doesn't put up earnings at some point, people would get sick of it and get tired of it. And in the case of Anavex or Cassava or Galectin or any of the stupid stocks we've looked at over the last year we've been together in biotech, clinical trial will tell you it's over, right? It doesn't matter if you're bull market or bear market. Clinical trial will tell you it's over, and the drug's not worth anything. So, and the black line, the value line is close to zero. So it doesn't even matter where the orange line is. So that's some theory of markets for you, but I feel like, again, the mission is the same. Find the stocks we feel really comfortable buying, find the stocks we feel really comfortable shorting, have that margin be so wide, and ideally over enough stocks that, we don't have to worry about things like timing. We don't have to worry about things like catalysts. We just sit and wait. And time heals all wounds, and that we can take a little bit of, an INQ going to 50. We can survive that. Because a 2% position becoming an 8% position doesn't put us out of business. Does it give us a headache? Yeah. It's annoying losing 6% of your assets. But, we're not going to lose, 90% of our assets. And when we buy something and it drops, is it annoying? Sure. But, if with enough stocks and enough time, we should be able to do well. So in any event, that's kind of some philosophy. Of course, philosophy and practice are two different things, and you're encouraged to do whatever it takes to get returns. Whatever works for you, whatever maximizes your returns, you do it. So we were working on this. If you don't have the time to wait, I'm not sure you should be investing. Buffett said investing is the process by which impatient people give patient people their money. So you need patience. You need time. If you can't wait, then I don't know what you're doing. But you should be able to wait. And I guess that's one of the problems in the hedge fund world with monthly performance, is that you need to put up a monthly performance number. The nice thing about investing for yourself, or investing for a corporation, or investing for, something like that is, your family, for example, is that you can kind of ignore the monthly noise. But even then, you need some performance barometer of some kind, right? And if you have a year or two of bad numbers, you will get eyebrows raised saying, well, what are you doing? But if you have really good methods, maybe you're just going to make a ton of money next year when the bubble collapses or when whatever happens. You still have to be, smart about how you do all this stuff. And again, there's no textbook. The closest thing to a method I have, I'm telling you, but there is no exact textbook. You have to be pretty nimble. And again,